Hey everyone. So today we're going to be focusing more on the quantitative side of things because this trade stems off of what we discussed earlier with XLF, and that is going to be on KRE. If you're not familiar with KRE, what KRE is, it is the Spider Select Series ETF for regional banks. And yes, regional banks have been the banks that have been failing, such as Signature Banks, such as Silicon Valley Bank, First Republic, etc. So what I wanted to do is really dig into this and basically kind of stem off of what we discussed with XLF into a more qualitative leveraged play. So let's just go over the numbers first. You're going to see that we have an IV30 versus forecast volatility of 1.35. So we have an implied volatility currently around 70%, forecast volatility around 51.5. Really good numbers. We like to see that. Continuing on, we also can see if we scroll down here that volatility has absolutely skyrocketed on KRE, right? Which would make sense. I mean, like this is the area where we've seen the worst of it in the financial sector. So on the surface, this might make sense, but we're gonna add a little context here to maybe pique some interest and hopefully have you guys conduct some further qualitative analysis because that may not be the case, right? Now, looking at why we would even consider this, right? Obviously that massive spike in volatility, but also if we look at the current volatility surface today, which is the blue line, versus 2 weeks ago, which is the green line, we can see that not only has the volatility surface kicked up across the space, we're also seeing severe backwardation, right? You see how this is sloping down? This could indicate that the market is expecting a lot of banks to continue to be under stress in the coming months, right? Or at least their stock prices. Now, the last thing I want to show before we get into the qualitatives, right, and the overall thesis here is a time series, a relative value time series between KRE's IV30 versus realized volatility, right? And then that's the ratio versus XLF. Now, what you're going to see is that they're pretty much in tandem here. But remember how I said this is a leveraged play, a bang for your buck type play? You're selling KRE vol at 70%, right? And if, markets cool off and things revert back to somewhat normal, right? It might get back down to 30%, right? That's a huge difference versus, 30 vols is a lot bigger than the difference for what you could get on XLF. You might get 15, but more likely probably like 10. So now let's go into the thesis and trade structure, right? The thesis here is yes, while KRE is in, regional banks, no bank makes up more than about 2% of the holdings in this company, right? And the banks that they hold are banks that are not particularly involved in the leverage tech plays like Silicon Valley was or like Signature was. They're not banks that have had financial problems for years like Credit Suisse. So what this could mean is that, hey, this might be trading right now. Like it is like KRE and all the banks in KRE are going to fail, right? But what are the odds that all these banks have problems, right? Think about why we're having these problems, right? The problems that we're having with these banks right now is that they were allowed to omit mark to market on their treasury bonds, right? So they were taking huge losses, but no one knew that they were taking huge losses, right? Because they weren't posting it. Well, the key now is, the Fed now, or at least the market thinks that the Fed is going to cut rates, right? Which would obviously improve the nominal terms of the treasury yields on bonds, right? So their losses would be mitigated somewhat. So this would reduce some of the stress. Also, as much as people want to compare us to '08, we're already seeing banks such as JP Morgan, like I said earlier, step in and help out banks such as First Republic. So it does not appear to be like '08, yet the market thinks that this is trading like 2008, right? Let's go back here and just show this one more time, right? Ridiculous stuff. So, structuring the trade, guys, this is just going to be really quick. It's the same ordeal. It's a short straddle. There's a lot of volume on this. Spreads are a little bit wide. Keep an eye on that. Make sure that it's not like that. If you do take a position in this after conducting additional research, you make sure that you're not getting killed by the spread, by the market makers. And yeah, that's the general gist, guys. So if you guys have any questions, feel free to comment below or message me. And if you guys have any names that you want us to take a look at, feel free to comment those down below as well or reach out. So that is all I have for this one, guys. Make it a great week. Peace.